Welcome to the Mutual Fund Show. I'm Neeraj Shah, and over the next 20 odd minutes, we'll talk all about a particular aspect of mutual funds, and which is whether the buy and hold strategy across funds, of course, works. And if so, in what instances are there exceptions to the rule? Because traditionally, I presume all of us have been told that if you buy right and sit tight, and I'm not trying to quote Motilal Oswal out here, but if you buy right and if you then hold on, then typically over the long term you would make money. But there are instances, or rather, there are specific time periods, if you will, wherein this may not necessarily hold true. So we'll try and examine if there are alternatives to try and figure how and why to take necessary steps in order to minimize the impact or eliminate it completely of when a buy and hold strategy may not work. But let's get in Vijai Mantri. He and his team have analyzed data going back multiple years. I'm sure it's been a rigorous exercise to try and get the inference out of this experiment and observation. I took you back to the chemistry class, Vijay. Good morning, rather good evening. Thank you so much for joining us on the show.
Thank you very much, Neeraj, and good afternoon to all the viewers and your team as well.
Yeah. So Vijay, tell us. When you sent me that mail, it was a very interesting set of data points and observations and inferences that came out of them. What is this whole buy and hold strategy about, and where or which instances or which situations or which periods have you found that it has not worked?
So it was a sort of a conventional wisdom to assume that when you're investing in blue chip stocks, or you're investing in index, or you're investing in equity mutual fund, you should just buy, fill it, and forget it. You should not even touch and look at your investment. And there are various studies shown that, for instance, one study in the US which showed that the best investor has been the investor who actually died because they could not look at the portfolio. So this is the thing which has been almost like, I was also one of the votaries of saying buy and hold, just don't touch your portfolio, do nothing, and it will meet all your requirements. But when you looked at hard data, the story is very different. So I'm still a big votary of buy and hold, but not in all the situation and circumstances. So buy and hold works when you don't have to take your money out, because in the long period of time, equity outperform every other asset category, and particularly equity outperform debt, fixed income, and also does much better than inflation, provided you don't have to take money out from the market at all. But suppose you have to take money out from the market for a specific goal, whether it is to meet some emergency, or a goal for child education or wedding, or most importantly, the goal for retirement, because that, in my opinion, the biggest goal an individual could have. There are many instances where the buy and hold actually has not worked. So those who talk about buy and hold are the people, not everybody is Warren Buffett that you live for 90 years and you don't have to touch a corpus. But normal folks, when they look at investing, there are two legs to the transaction. One is investment. The second leg of transaction is disinvestment. So until as both the legs are done, the transaction is not completed. So when you take money out from the market for a specific goal, then there are many incidences, and they are quite sizable incidences, where the buy and hold strategy actually has not worked for the investor. And we would try to examine these in next 15-20 minutes.
So Vijay, just before we get to the hard data, what you're effectively trying to say is that if people make an investment or invest money into funds with the purpose of using them at some point of time and not necessarily keeping it as an investment alone, then the buy and hold strategy sometimes works, but sometimes doesn't work as well. In that, it may not give the best outcome.
That's very true. And our research shows that, and we went back to data from 1980 till 2020. So we looked at BAC census data for almost 40 years, and the results are very, 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 very interesting. So if you allow me, I can explain you that how we have done it.
Please do.
So for instance, what we assume that, let's look at the one goal. That goal is of retirement. And we assume that when people retire, they at least have a requirement of 20 years that a typical Indian would retire at the age of 60, and then he or she would look at the corpus to last at least for 20 years. Then actually the corpus is meeting its requirement where your entire retirement expenses get funded through disinvestment from your corpus. So what we have done here is very simple exercise. We looked at the 1 crore corpus, which the investor could have invested or he could have created over a period of time. So on the day of his retirement, let's assume he has a 1 crore rupees corpus. And then from month one, the investor start taking, in year one, he takes out 8%. So 8 lakh rupees the investor takes out because that is what he thought will do much well, because the Sensex delivers 16% CAGR over a 40-year period. So let's look at even half of that. So we assume that the investor takes out 8 lakh rupees per annum in equal monthly installment of 66,667 rupees. So from month 1 to month 12, the customer takes out 66,067 rupees. From month 13 to month 24, this amount goes up by 6% and then 6% year after year, because we have to account for inflation as well. So we have done this exercise that you start with 1 crore corpus. Year one, you take out 8 lakh rupees. Year two, 8 lakh plus 6%. Year two plus 6%, 3 plus 6%. So you keep increasing your withdrawal by 6% per annum. So we have done that number. Now, when we apply this number on BSE Sensex from 1980, let's say somebody started with the corpus on 1st April 1980. What would have happened to that person as on date? Or 1st April 1981. Every year we have taken first day of the financial year. So there are 41 observations we looked at, and we could share what has happened in these 41 years, where in 2/3 of the years, there was a great years where not only the investor has taken out a lot of money, but the corpus as on date is very sizable. There are some incidences where almost in 1/3 of the incidents where the corpus has not lasted 20 years. So the buy and hold strategy, which has worked very well when you don't have to take money out, has not worked for you 1/3 of the time when you have to take money out to meet your retirement needs.
Okay. Now, viewers, just keep in mind this 8% number, as Vijay explained, is a number that comes in because if the market went up 16%, you take half the money out. It could be any number. The idea is, I think it's been worked with 8%, and 8% I think is a normal number. I mean, 8% of whatever that corpus is arguably the size that people would want for expenses. Now, Vijay, how do you want to take this forward in terms of explaining the numbers? Should we talk about the 1/3 of the instances where the corpus didn't last, and what do you mean by the corpus didn't last? I mean, did people stop investing and then 20 years post that date? How did you come about this 1/3 of the instances?
So we assume that somebody started with a 1 crore corpus, okay, and suppose somebody started say on 1st April 1980. As on that day, as on this day, the person has taken out 23 crore rupees in last 40 years, but still the corpus is more than 100 crore rupees. If somebody started from on 1st April 1980, but suppose somebody started on any other day, the amount of the corpus and the amount taken out could differ. So I call great year. There are some 25 great years. 1980 to year 1990. Those were years in which if you have taken money out, if you've invested and you've taken money out, there's still the corpus is anything between some 23 crore to 100 crore plus. So these were the great year. In between, there are 2 years, 1986 and 1991, where the corpus has finished by now, but the corpus has served you for 27, 28 years. So if anything lasted more than 20 years is a great because you plan for 20 years. So year 1986 and year 1991 were the period. Suppose you started at that time, then the corpus has lasted till 27, 28 years. But suppose you started on 1st April 1992 or 93 or 94 or 95 or 96 or 97 or 98 or 99 or year 2000 or year 2006, 7, 8, then the corpus has not lasted 20 years. In some of the incidences, the corpus has just lasted 7 years. Suppose you started on 1st April 1992. Then the entire corpus got over in October 1999. So it varied from 7 years to 17 years during that period from 1992 till year 2000. Then again, you had a great period of 2001, 2002, 2003, 2004, 2005, even to certain extent 2006. But suppose you started in 2007 and 2008, then in those 2 years of a starting period, the corpus got over in around 12 years period. So it didn't last 20 years. So we're not talking about Harshad Mehta days of 1992, where the market ran crazy valuation. We are talking about the current market, just not 10, 12 years back. And even if you see data for 2010 and 11, if you started your corpus on 2010, the total corpus available to you or 2010 or 11 is around 34 lakh to 50 lakh rupees. It means you just covered 10 years of expenses. You have 10 more years to go by. The 8 lakh rupees today would have been 11, 12 lakh rupees per annum right now. So perhaps the corpus may last 4, 5 years. So even as recent as 2010, 11, the corpus would not last more than 15, 16 years. So you could safely presume that out of 41 years, there are 14 years in which the corpus has not lasted 20 full years. It means around 34% of the time, the buy and hold strategy has not worked when you have to fulfill your retirement needs. So what does it imply is when you start and when you take out money, what phase the market is at that time matter a lot.
Viewers, I know one of the questions that might be coming to mind is, but if you started in 2004 or 5, you haven't seen 20 years, but which is fine. There's nothing that can be done about it. I think the bigger point is that if you started, Vijay, as Vijay said, in 2006 or 7 or 8, then you don't need 20 years to tell you that the corpus hasn't lasted because it got exhausted well before time, 12 years or 13 years. And therefore, Vijay, my question to you would be, would it be because people and a retail investor, an average retail investor, or maybe even a sophisticated investor, is no one to be able to predict that things will definitely last 20 years or no, that maybe there could be, are there some hacks or some, how do I say, tricks around how can one make this happen? Because otherwise it seems to be a bit of a random choice, right? If it was 90% and 10%, then it's separate. But if it's 2/3 and 1/3, which means it's almost difficult to predict that if you started this year, it will necessarily last for the whole 20 years or no.
That's very true. And you are absolutely right that 1/3 time, it means that 2/3 time it worked. 1/3 is a big number in percentage terms. So statistically, we could say that 16% is CR Sensex delivered in last 40 years, but that is statistics. When it comes to your number, you could be in 1/3. So it's like when you go for open heart surgery, the doctor will say you the chance of you dying on the operation theater is 1 out of million, but for you it is 50%. So the statistics on large number is a number, but when it comes to you, it could be tragedy or it could be anything else. So it is very important to look at this data very, very closely and figure a way out what can be done. Now, what would happen in future, nobody can predict because a random walk. It is not the question of market destination after 5 years, 10 years, 20 years. Everybody knows that over a 10-year, 15-year, 20 years period, market would be much higher from these levels. There's no question about it. And it is last 40 years data in India or last many years data in US market do suggest then the long-term equity market does very well. But what is most important is that what happens when you are taking money out, what phase the market is at that time. So you cannot be sure at all that what would be journey of market from here onward for the next 3, 5, 10, 20 years kind of thing. So given that kind of situation, what does investor need to do? I think that is a very important question to be asked, that if the buy and hold situation data clearly suggests has not worked, and mind you, those were days, last 40 years, in 92 to year 2000, interest rate was 12%. So if you didn't have money in equity, you could fund through debt. But today's situation is very different. So today, if that kind of situation to happen, then the even debt portfolio will not able to take care of your retirement needs. So yes, we need to create a mathematical formula based on culling the past data, looking at the past data, churning the past data, going deep into the past data and figure out what is my best strategy where whatever happened in past, if suppose the same thing get repeated, the 1/3 chances come down to 0%. Yes, there are possibilities this can be done, but perhaps I think we need to have a separate show because I worked on that and there also required a lot of explaining, but perhaps we'll take some time gap and then we'll come back to our viewers saying that if you need to fund for retirement and you need to keep buy and hold a strategy, then here is a mathematical formula that would satisfy your needs.
No, fair call. So, viewers, yes, is there an answer right now? Well, maybe there is, but is there an answer that is coming in from Vijai Mantri, whose team has done this? I think it comes in maybe 2 or 3 weeks from now. But Vijay, one answer that I would surely expect from you, and because this is on the points that we've spoken about thus far, were there any specific reasons why in some of the cases the corpus lasted for only 7-8 years? Did it have to do anything with obviously everything had to do with market behavior, but are there some common threads between all of this, or is it not really that common and it's very random?
No, it's very, very interesting. There's a common thread to the entire thing. And suppose you look at 1992, market has collapsed 50%, but the corpus lasted 7 years. But suppose you look at the same data for year 2000, then the corpus lasted 12 years. So even in 2000, the market was at peak, but market recovered very fast from 2001. And then we had a great period from 2001 to 2005-06. But from 1992 till 2004, the equity market, Indian equity market was almost flat. So why this phenomena happened? Why the corpus didn't last? Actually, it is just a reverse of SIP. SIP deliver you best performance when the market is in bearish phase, because during that time, your monthly purchases allows you to accumulate more and more unit in bad market timing. But when you are taking money out, and suppose at that time the market is in bearish phase, then the reverse happen where you take more and more units out, and when the market start recovering, perhaps you don't have too many units to last to meet your retirement needs. So it is just the reverse of the market, and what matters is that particularly in initial 4-5 years of your withdrawal, suppose the market is in bearish phase, then definitely it impact your corpus hugely.
Got it. No, fair point. And probably a very simple answer to this, but yeah, it's almost unpredictable, viewers, and therefore important to try and figure out a hack or a strategy around it. We'll try and do that. But before we wrap up this show, and I hope this is an eye-opener in more ways than one. If you are a believer of buy and hold, try and examine some of the data points that we've given here, and the story that we will write on this show towards the end of this week, for you to be able to kind of question your thesis. It's always good to question every thesis that each of us has, right? Hypothesis that each of us has. But Vijay, just before we wrap up this show, and we've discussed this piece, and I trust that you will be back with us in 2-3 weeks or 4 weeks from now with the answers thereof. I have one more question, and that has now become center stage. We will of course do a whole show on it, but just a quick question to you on expense ratios. And very recently, and maybe I've missed the others, but very recently there was this instance of how an active fund from the house of ICICI approved has expense ratios which are similar or fairly low and comparable to maybe even passive funds, so to say, or maybe not comparative, but pretty low. And therefore it kind of diminishes the, how do I say, the differentiating factor between an active and a passive fund, if you will. Now, a lot of people I know go about and choose the active or the passive fund option based on the expense ratio, and naturally so. Is that line getting blurred, and do you think more and more AMCs would probably go down this path? Why or why
it
not?
Is not. So the index fund, the expenses choice is there with the market participant. Someone want to run it much lower, someone want to run at 10-15 basis point. But when it comes to the direct plan or normal plan, the choice is not there. It is a casuous, it is a cause and effect relationship. So let me explain you how it happened. In a normal plan, SEBI has prescribed the formula First 500 crore, 2.25%. Next 300 crore, next 200 crore. So it goes like that. It goes to 1.05%, and anything about 5,000 crore, then it keep dropping by 0.5%. So if fund is 10,000 crore, the effective expenses is 150 to 160 basis point, 1%, 1.6, 1.7. Now, how the direct plan expenses are calculated in the same scheme? Suppose a scheme A have a 1.75% weighted average expenses. We call it TR, total expenses ratio. Then out of that, whatever on weighted average basis the fund house is paying to distributor in form of commission, in form of event, in form of taking them out for a picnic, whatever money you are spending on distributor, the entire thing is taken as a distribution expenses. So you minus that, and the rest is the expenses of direct plans. So for instance, a fund house has 1.75 basis point TR in a normal plan, and that fund house pays 1.6% distribution commission, then 1.75 minus 1.6, 15 basis point would be the expenses ratio for the direct plan. If next year the fund house expenses drops down because next year trail commission come down, this could be in year one they are offering higher trail commission because ICICI Flexi Cap Fund had just launched and they paid high commission in the year one or perhaps year two. A lot of commission they paid. So in year one, the expenses could be very low in direct plan. But suppose in next year, the broker plan expenses come down, brokerage expenses come down from 1.6 to 1%. Immediately, you will see the direct plan expenses also going up. And that is the reason you keep seeing, you are getting a lot of email from the fund house where they're saying TR of this fund has changed this much, this much, this much. So it is a mathematical formula. It is typical of a particular fund, but industry level, I do not think. Suppose ICICI Flexi Cap Fund, I'm guaranteeing you after 4 to 5 years or after even 2 years, the expenses in direct plan will not remain 0.17.
Sorry, Vijay, just one last question. I know you explained it briefly, but can you tell us why do you say that this won't happen? And are you saying that the expenses of the direct plan, the expense ratio of the direct plan will move up? Why so?
Yes, because their total expenses on the fund level. Now there are two plans, broker plan and direct plan. In the broker plan, you pay brokerage to broker. ICICI Flexi Fund was just fund which got launched. So perhaps they paid more money to distributor in the year one commission. So perhaps they paid 175, even whatever. And that was the year one trail commission. Year two, the trail commission come down to 75 basis point or 1%. It means the expenses, the brokerage you paid in year one, 1.6%, come down to 0.75 or 1%. Then your direct plan expenses will go up because direct plan is a result of normal plan minus distribution expenses. In year one, distribution expenses were higher because you launched the NFO. Year two, year three expenses ratio will come down. When the brokerage will come down. The moment brokerage will come down, your direct plan expenses ratio will move up.
Okay. Vijay, but that would mean that the regular plan expense ratio should come down. Why should it result in the direct plan expense ratio moving up? Because that would remain a constant, right?
The direct plan expense ratio is resultant of total TR.
Yeah,
so
got it.
So the TR is based on a formula. It's based on how the assets are built up, and you reduce the distribution expenses. It is a resultant component of that. Okay.
Got it. Okay.
It is a little technical. I don't know. Viewers perhaps will, and they can tweet and we can respond to them in greater detail.
Yeah, but that would also help, and maybe explaining this in great detail would help because I think a lot of people get those emails, as you said, that there is a change in the TER, but people don't pay heed to it because it's such a small part, maybe, of the overall bit.
But it keep increasing. It keep increasing. So what you will see, 35 become 37, then 37 become 40. So what do you see? 37 become 40, 40 become 42. You say 40 basis become 42. You forgot that it 1 year back it was 35 basis point. Now it is 60 basis point.
Got it. Okay. Vijay, this was nice. Thank you so much for both the explanations. I think we'll have more explaining to do when it comes to the TER. And I'm sure viewers are looking forward to understanding the hack to a buy and hold strategy that might work for all times if indeed they still have to go out and withdraw some of the money. Let's see if there is some like that. But Vijay, thanks for bringing that data and thanks for joining us on the show today.
Thank you very much, Neeraj. And just a small thing to viewers that I'm going to release a separate video on this where far greater detail data, because there's a challenge to the medium. I could not put so much data, so viewers can see maybe 7 or 10 days later, year-wise data, how much they have taken money out, what are the corpus today year-wise. So I think that would perhaps help them.
Great. Okay, viewers, you can make use of that as well. But Vijay, thanks for joining us on the show today.
Thank you very much.
And viewers, thanks for tuning in on this leg of the Mutual Fund Show.